Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me, Sidney Freed, known far and wide as the people's voice. Kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Today, we are welcoming back Peter Borish. He is the Chairman and Chief Executive Officer of Computer Trading Corporation. Previously, he was Paul Tudor Jones' Director of Research at Tudor Investments. Hello again, Peter.
Thank you.
Today, we are going to break down the markets and the U.S. economy as we are now about 1 month out from President Trump's inauguration. Our phrase of the day is strong dollar. Do we even want one? Or is it a political football? We discuss with a nod to Bob Rubin. This episode is brought to you by the number 7, as in the 7 C's of commodities. From coffee to crude oil, is it futures time to shine? Or does Powell quash the supercycle party before it lifts off? And Peter, there's a lot going on in the market, so just give us your big picture overview.
Wow, there is a lot going on in the markets. Well, my big picture overview is very simple. You had two 20% years under Biden, who was, obviously terrible, just like we had two 20% years. The last time that happened was at the end of the Clinton administration, and oh boy, that was terrible too. So like Ken Griffin said yesterday, a little bombastic, a lot of uncertainty, I don't think is overly sanguine for the equity world. And the only thing I'm really confident of is that interest rates are going up, particularly in the 10 and the 30 year. And for those of you who really like to go into minutia, the Japanese 10-year yield, which was at 0, is now at 135, which is mind-boggling quick ascent. Yet the yen has not really strengthened.
I think we're going to get into a lot of that. That sounds interesting. I want to get to our phrase of the day now, and this kind of ties into it. It is strong dollar, and it's a loaded term, and we're going to provide some context here, and then you can comment on it. So a strong dollar just refers to a U.S. dollar with high purchasing power, appreciating against other currencies, which generally benefits imports, but generally hurts exports. And there's a lot of jawboning around it. And presidents often like to say, we want a strong dollar. I mentioned Bob Rubin before. In the 90s, he was kind of a proponent of it. But then when it gets too high, there's a lot of pushback because a strong dollar means things are more expensive sometimes for people. And in generally, it can, if it goes too high, too fast, it puts a kibosh on risk trades. So what's your view on the strong dollar here?
Well, the dollar's going to get stronger until, and this is always the interesting part, right? Republicans are like, oh, we believe in free markets, until they don't like the temperature, so then they break the thermometer. So under Reagan, we had the major intervention when the dollar was stronger in 1985, September. My guess is if I was gonna think about that, I believe the euro is probably going below par. I don't know if it's gonna make all-time lows below 82. And then these free market men will intervene because they don't like the temperature. We saw that again in the 70s, under Nixon, where they didn't like the temperature, which was rising inflation, so they put on wage and price controls. So my biggest fear is that the people who are now in this administration believe they can control events when history always suggests events control them.
Let me ask you, let me ask you though, what's too strong of a dollar? Is there a level?
Or is it the speed? I mean, it seems like when it goes too far too fast, it just kind of wrecks things, and that's a wrecking ball. But is there a level?
So, great point, right? Trading is a second derivative issue, not a first derivative, right? So it's the rate of speed. The dollar's been pretty low rate of speed in terms of the change of how it's been getting stronger. So I don't think that's an issue yet. But policies have implications. If you're going to put tariffs on, how do you fight that? Well, guess what? You depreciate your own home currency. That then offsets partially the impact of tariffs because the dollar gets stronger. So there's this tug of war, and when things get out there, and I know this is a shock to a lot of people, but people in this administration, they tend to have ego. So if it's not working, they're going to go more. And they're going to go until something breaks, and that'll probably be a second derivative speed of the dollar.
Let me ask you about rates here, and this ties into inflation as well. We're taping this on the back of a hot commodity or a hot CPI report that we got, and just kind of blew away expectations to the wrong side, to the north side. What does the Fed do from here? We've heard inklings of Fed rate hikes now. We're supposed to be in a cutting cycle, but I'm hearing rate hikes for the first time in a while. What does the Fed do, and how does the market react?
So one of my lines is, one of the most popular jobs on Wall Street is every 3 months forecasting the Fed is going to cut in 3 months. And so they just keep pushing it out.
It's like up there with those recession forecasts.
Yes. And the reality is that if you look at the 2 years since the Fed started cutting, the rate has gone up. Obviously, the 10-year and the 30-year. The Fed is a reactor. It's always been a reactor. It is not an actor. So if the market rates continue to go up, that's going to put the Fed in a conundrum. And once again, people in the administration, including the president, they don't like the message, which he said this morning. So, okay, you should just cut rates. So let's break the thermometer. That's not going to happen. The flip side of a trade deficit is a capital surplus. So if we really push that down, who's going to be the marginal buyer of our treasury debt? So that's a concern, right? More supply, less demand, prices go down, and therefore interest rates go up. And at the same time, and I have yet to see this, and it would really be great, what's happening with the debt ceiling? All of a sudden, in the last administration, they were supposed to do emergency
That's
measures.
something else you hear about every 3 months, like clockwork.
Yeah, but, okay, so they're just going to ignore that. Oh, and by the way, right, 3 weeks from now, the continuing resolution expires, March 14th or so. So what does that mean? So in one sense, all this argument and legal stuff about Doge is irrelevant if you just shut down the entire government.
That's an interesting point there. There's so many moving parts when we talk about the interplay of the bond market and sovereign debts, and you brought up Japan, and I just want to get back to that as an interesting example, because Japan, their rates, as you were saying, their 10-year rate, which was at zero for years and years, maybe decades, has just lifted off. And then when the currency, the yen, has not really kept up with that, but in international markets, you always have the currencies interplaying with the bond market, and sometimes they get out of whack, and then sometimes things need to catch up real quickly. Are we at that point with the yen?
So I think that the yen has a real good chance of breaking through 160. It's at 154 or so today. Japan is kind of the odd person out of all this, right? You haven't heard arguments against Japan and how it's trading, but it's a big net importer of energy. So if we go back to the 7 Cs and those prices go up, that's going to end up weakening the yen. And in fact, there's a nice correlation there between energy prices and the yen.
How should a U.S. investor think about the yen or anything overseas? Like, is it an important thing to follow for someone who's just invested in, let's say, ETFs?
Passive investor. Do you have to worry about the yen?
Yeah, so what's happened over the past decade is diversification has not been your friend. So as you know, I happen to be one of the greatest at this, which is predicting yesterday. If you want to know what happened, I'm probably your guy. Tomorrow's a little tougher. So in the recent past, the U.S. has largely outperformed European non-U.S. markets. That is likely, and that has already started to change if you look at a chart and you look at the relative strength, that those markets, why? Because I think there's that term that Ken Griffin used yesterday, right? Chaos and bombastic. That's not good for our markets. So the overseas markets now are a place to potentially go in terms of diversification.
You know what's really interesting, Peter? As you say this, I have kept in my mind here that since the inauguration, we've seen significant appreciation in the stock markets in other countries, like everything from Spain to Germany. You look at the DAX, it's been hitting record highs. And we've seen a lot of emerging markets, even China has perked up since the inauguration. Do you see this as a trend that continues? Because EM has been kind of dead for a large part of the century.
I do see it continuing, primarily because of where we are in our own cycle. So given the size of the fiscal deficit, that has definitely muted the Fed and monetary policy. So if you're going to try to go, as Treasury Secretary Besson said, to 3% from where we are, 6.5, 7, that's very contractionary. That's not good for growth. So that makes overseas look a bit more attractive. And oh, by the way, how are you going to get there?
Well, I think that's a big question here. And one of the things that sticks out in my mind as we're talking here is Liz Truss over in England was in power for a very short period of time. The bond vigilantes, they got her over there. She wanted to enact a bunch of changes. Bond market disagreed, said that's not possible. And then the monetary authorities had to capitulate. Do you see some kind of reckoning happening in here in the United States? Not necessarily along those lines, but a reckoning where we have things out of whack now.
So markets spend a lot of time going nowhere, and then they reprice.
Yeah.
And interest rate cycles are very, very long. We're in the early stages of a rising interest rate cycle, which started in 2020. And I think we have a long, long way to go, whether that's bond vigilantes, whether that's the fact that our fiscal deficits are going to continue. Remember, you've got a flow, which is a deficit, and then you have a stock, which is the debt. So even if you take the deficit down, the debt level is still going up, and you have to finance that. Without balance, everybody needs balance in life, right? Your food, your exercise, and markets need balance. And if we don't find that, rates are going up, and probably faster and higher, in my opinion, than the consensus.
So what does this long path actually look like then down the line?
Yes.
That's the tricky one, right? So
It took us 30 or 40 years to get here, to the turning point, and here we
yes.
are.
So think about it this way, and as I was saying earlier, I'm a good keeper of insignificant information. From 1944 to 1982, interest rates went up. And the biggest moves were in the last 2 years, right? 80 to 82 under Volcker. Then from 82 to 20, interest rates went down. And of course, the biggest moves were in the last 2 years. But if you take a chart of bond futures, about 50% of the months, they were up. So rates went down, but they don't go in a straight line. So that's the thing. And then we, of course, anchor to the recent past. And
Recency bias, sure.
yeah. And so rates were lower. So now we keep thinking every day they go down, we think, oh, we're going to go back down. That's not the case according to, my study of history and markets.
Peter, we got to take a short break, but coming up, we're talking about the 7 C's of commodities, plus a look at the ghost of bull markets past. All right, we are back, and this episode is brought to you by the number 7, as in the 7 C's of commodities. They are coffee, corn, cotton, copper, crude oil, and cocoa. What is
Live cattle.
Say it
live
5
cattle?
times. Say it 5
live
times
cattle.
fast.
Thank you.
Cattle.
I'm not going to say that 5 times fast, but I will ask you, what's the significance of the 7 C's?
So to me, it's an easy way to think about potential inflationary pressures. And it's a set of diverse commodities. People look at crude, it went up, it's in sort of the middle of the range. But if you look at corn, for example, that's broken out. And
Coffee. 14 days to the upside. Ooh.
right, coffee's at 60-year highs, cocoa's at all-time highs, never mind eggs. I wish I could spell it wrong with the
Up
C.
15%
But-
this month.
So when you look at all these things, they've all broken out. They've all sort of, if you look at traditional trend following models, they've all recently given buys, except for cotton. And I'm watching cotton, and part of
That's
that is,
apparel.
yeah, and that's the China tariffs, aggregate demand level. So the tricky part here is this number and the inflationary numbers look like they're going up. But beneath the surface, there's this huge tug of war. So we just talked about interest rates. If you had 7, 10-year ARMs, right, and refinance when rates were low, those are coming up. So that could be a big factor in sort of hurting potentially the housing market. So if you can't afford that, you're going to add supply. The housing market itself has held up by the numbers, but the number of transactions has dropped significantly, and that is an indication that in an illiquid market, the price can drop pretty quickly when someone has to reprice it.
Let me ask you though, if there's 7 of these C's, if like 4 of them are feeling the effects of inflation,
need a
does that
quorum
mean
or a
something?
majority of
a
the Cs?
quorum or a
Right.
majority, or if all
Yes.
7 are really
Yes.
inflated, the world is ending. Like, what does it mean?
I'm not one that believes that the world is going to end.
No chicken
and,
littles, yeah.
and I'm also one that likes to say that, the people on the outside holding the signs at the end of the world is here.
Some of those are outside.
They all have
here.
one thing in common. They're generally not very wealthy. So you
True.
need to be an optimist over time. But when all the 7 C's are signaling, that's saying that there's a likely pickup in inflation, and particularly the subsurface numbers that people track, and certainly the Fed tracks in PPI. So it's more than just energy. So cattle, when that's up, right? Eggs, bacon, go back to trading places, right? When they're sitting there going, oh, a bacon, egg, and cheese sandwich, right? So it was traded on the old exchange.
Sure. And hold that thought. I want to get to today's Who or Better. This directly ties into the market action that we're seeing today. And typically we do kind of a runway contest. Today I'm going to leave it open-ended. I want to ask you, is there a historical analog to what's going on in the markets right now? What is that period of time? We've only got about a minute and a half.
A minute and a half. I'm going to say that this current administration is very similar to the second Nixon administration.
Nixon 2.
Nixon 2, 72, Trump 2. And where is that? And by the way, we talk about the history of Wall Street, and Alan Greenspan came in 1974 as chair of the Council of Economic Advisors, and they didn't like it, as I said earlier, that inflation was picking up. So these men who all believed in, and by the way, they are mostly all men, particularly back then, put in wage and price controls. We all remember the whip inflation now. That did not work. At the same time, you think about the Middle East, right? It was the Yom Kippur War in the fall of 73, 74 that took place. So these events and supply shocks are likely to take place when you're trying to intervene in the marketplace. So I sit on the risk committee at CIBC, and I'll just say that if you can't model it, you can't price it. That's a hard part for people in markets right now. How do you model all this uncertainty?
All right, I like that. Right now, we got to take a deep dive into options, where we uncover strategies, trading styles, and mindsets to help you learn the options trade, sponsored by Tasty Trade. And now, as part of our Trade This Way segment, sponsored by Tasty Trade, joining us now is Sean McLaughlin. He is the Chief Options Strategist at All Star Charts. And Sean, thank you for joining us here today. Let's start out with the very basic definition of an options contract. In fact, this is a call contract. This is what we're going to focus on today. It is a financial contract that grants the buyer the right, but not the obligation, to buy a stock at a predetermined price within a specified time frame. And on our screen here, we're going to show you how a call option breaks down. You control 100 shares. You have to do this by an expiration date. There's a strike price that matters on that expiration date, and you also have a premium price. Tell us how this all fits together, please.
Well, you explained the call very well. The one thing I will add is the advantage a call buyer has over a stock buyer is that a call buyer's risk is limited to the premium he paid for that call. So if the stock has a bad gap down against you past your stop, if you own stock, you're going to get hurt worse than you planned, right? The stock is going to blow right through your stop loss order. You're going to get filled at a much lower price to get out. The call buyer, the risk is defined to the premium they pay. So this stock could go to zero overnight, but all they're going to lose is the premium they paid for that call.
Defined risk. Love it. All right, we're going to advance to our next slide, which actually belongs to you. You prepared this. There are different ways of selecting options. You can have a bullish bias or a bearish bias, and the environment in which they're selected, low volatility, high volatility, matters as well. Tell us how you use this Foursquare, please.
Sure, Jared. So this is not an exhaustive list of strategies that I employ, but these are common strategies that I use based on where volatility is in the name. So when I decide that I'm bullish or bearish and I want to get involved, before I put a trade on, I want to assess where the implied volatility is. Implied volatility measures the expensiveness of options. And when volatility is high, I generally want to be a net seller of options premium because volatility, when it's high, tends to mean revert. Not always on my schedule and not as fast or as quick as I would like it to, but you can bet that over time, implied volatility will mean revert and the high premiums will decline. So I like to be a net short seller of premium in that environment. Now, if volatility is low, I tend to be a long buyer. So I might just buy calls if I'm bullish. I might buy puts if I'm bearish, or I might buy some kind of debit spreads to express my bet. But implied volatility informs my trading decision.
All right, we want to move on here to an example. And here we have a trade that you gave us. This is the IBM 300 September call, and this is a profit and loss chart. So at the bottom, we have the IBM share price at expiration. That's the y-axis. And you can see there's a break-even point. At one price point here, below that, you're going to be losing money. Above that, you're going to be making money. And that's the red and the green. Just break down this chart for us in the trade and why you're thinking about it like this.
Sure. So this is a IBM September 300 call that right now would cost about $8.23 to get in. So if I'm still in this position on the expiration day in September, I need IBM to be above 308.23. That's the 300 strike price plus the $8.23 I paid today to get in. Once I'm over 308.23, everything else is pure profit. I'm moving 1-to-1 with the value of the stock. So if the IBM closes at 350, well, my call value is going to be $50 because it's a 300 strike call. It's $50 in the money. And hey, I paid $8.23 for it and I could sell it for $50. That's a pretty great return on my investment.
And Sean, we got about a minute left here. Just any final words for investors about risk management? We've been talking about how if you're an options buyer, that can be defined risk. But in general, how should traders be thinking about options to use them prudently?
Prudently is the key word. There's lots of scary stories out there of people getting in trouble with options. And certainly if you're a naked short seller, you can get into all kinds of trouble. But for me, the way I like to do it, I tend to do most of my trades with defined risk. And I like to size my positions in a way that worst case scenario, I'm going to lose maybe 1 or 2% of the total value of the capital in my trading account. That allows me to sleep well at night, Jared, and allows me to spread my risk amongst lots of different trades, lots of variety, having some bullish trades, some bearish trades, some that expire next week, some that expire next month or 6 months from now. The more diversity I can put into my portfolio, the better odds of success I have over the long run.
Wise words. Always define your risk and watch your stops there as well. Sean McLaughlin, All-Star Charts, thank you for tuning in here. Thank you for joining us. And for the viewers, be sure to tune in next week for a brand new episode of Stocks in Translation on Yahoo Finance.